Imagine for a second that you're looking at a company's financial statements.
Yeah.
You're, scanning the balance sheet, checking the statement of changes in equity, and everything just seems flawless. Like the assets equal the liabilities.
Right, the math is perfect.
Exactly. The math is perfect down to the very last rupee. But what if I told you that this mathematically perfect document might actually be hiding a massive material truth from you?
Oh, it happens all the time.
Right. What if the illusion of clean math is being used to mask a fundamental reality about the business you're investing in? Well, welcome to a new episode on the JAP Advisors and Assets Clinic podcast.
It really is a scenario that plays out far more often than we'd like to admit in this industry.
Yeah, I feel like we've been conditioned to believe that if the numbers balance, the financial statement is automatically compliant.
Oh, absolutely.
Yeah.
But the framework of Indian accounting standards, it goes far beyond simple arithmetic. It's fundamentally about communication.
And when that communication breaks down even slightly, the consequences are just severe.
Yeah. Very severe.
So that's exactly what we're unpacking in today's deep dive. We're looking at a real-world example of how a seemingly innocent formatting choice, like literally a missing cross-reference, can legally and functionally obscure critical information from the markets.
It's a fascinating case study.
Before we get into the actual mechanics of this, let me just set the parameters for you, the listener. The observation we're analyzing today comes directly from the published Ind AS financial statements of an actual listed company.
And, it's really worth noting how this observation even came to light. This was a suo motu review by GAAP advisors.
Right, suo motu, meaning they didn't wait for a client to request an audit, right?
Exactly. They weren't hired to find a flaw. They proactively downloaded these public documents on their own initiative and just stress tested them against the standards.
Which is such a cool way to operate. It's an excellent way to see how the standards are actually being applied or, misapplied out there in the wild.
Yeah, outside of those perfect theoretical textbook scenarios.
Totally. And for those of you who want to follow the paper trail, this specific observation was detailed in the 225th edition of the GAAP Advisors Task Weekly newsletter.
That's right.
That newsletter is authored by C.A. Manish C. Iyer, who is the director of GAAP Advisors, and I think they've actually published over 230 editions to date, which is wild.
It's a massive repository of knowledge.
Yeah. So if you're on LinkedIn, I highly recommend you subscribe to that newsletter for free. It's just a fantastic resource for this level of granular analysis.
It really is. But before we dive into the technical breakdown, I do need to provide a necessary baseline disclaimer.
Oh, of course.
The views expressed in this deep dive are the personal views of the author and are not binding on the audience. You are strongly requested to seek the help of a qualified expert before taking any action or, refraining from any action.
Yeah.
Based on the views we discussed today.
Yeah, because every corporate structure has its own unique context.
Exactly.
Okay, and just to establish the structural boundaries of our discussion today, so we're all on the same page. We are looking at a standard reporting period, so that begins on the 1st of April and ends on the 31st of March.
Correct.
Furthermore, the functional currency and the presentation currency being discussed here is the Indian rupee. Therefore, any currency that is not the Indian rupee is considered a foreign currency for the context of this specific analysis.
Perfect. That sets the stage nicely.
Awesome. So with that out of the way, let's look at the evidence. The trigger for this entire deep dive is a single, incredibly simple table found in the company's statement of changes in equity.
Right. And the statement of changes in equity, that's critical real estate in a financial report.
How so?
Well, it's the primary map that tells a shareholder exactly what happened to their ownership stake over the course of the year.
Okay, that makes sense. And the table presented by this listed company, it was under a section labeled a equity share capital. It's just 3 columns wide. It lists equity shares of Rs1, each issued, said subscribed, and fully paid up. And those columns are particulars, no of equity share, and amount.
And right above the final column, what does it say?
It clearly states amount in euro, which aligns with our presentation currency.
Visually, a table like this is designed to be easily digested by the reader. Yeah. It aggregates data into a very clean summary.
Exactly. So let's look at what the summary actually says. The first row gives us the starting point. As at April 1st, 2018.
Okay.
The company reports having 663,495,495 equity shares. And because the face value is 1 rupee each, the total amount is exactly the same, roughly 663.4 million rupees.
That's a pretty sizable baseline.
Yeah.
So what happens in the subsequent rows?
That's where it gets incredibly quiet. The next row reads, changes in equity share capital. and the entry is just a dash.
A dash.
Zero. No movement whatsoever. So the row for the end of that year, as at March 31st, 2019, shows the exact same 663.4 million shares.
And I'm guessing it doesn't stop there.
Nope. The pattern repeats for the following year. Changes in equity share capital leading up to 2020. Another dash. Zero movement.
Wow.
Yeah, the final row, as of March 31st, 2020, lists the exact same number of shares and the exact same rupee amount.
You know, if we step back and view this through the lens of behavioral finance, we really have to consider the psychological impact of a table structured exactly this way.
What do you mean? Like how it makes the reader feel?
Precisely. For a primary user, say, an institutional analyst or a retail investor who's scanning hundreds of pages of disclosures, this table projects an overwhelming sense of stability.
Yeah, I mean, it looks completely static.
It does. The implicit narrative here is, hey, nothing has changed, there's been no dilution, the board hasn't issued any new shares, our capital structure is an absolute bedrock.
Right.
It essentially invites a reader to simply nod, check the box, and just turn the page.
I've got to be honest, I'm looking at this table right now, and my instinct is to do exactly that. It's clean, the math is obviously correct. 663 million shares at 1 rupee each equals 663 million rupees. Right.
It's perfectly balanced. So why is Gap Advisors raising a red flag over a table that is factually accurate and mathematically sound?
Well, because in the realm of financial reporting, factual accuracy is really only half the battle.
Okay.
The other half is compliance with presentation standards. The danger here lies in what is missing from that clean, static picture. And the framework governing this is Ind AS 1, which dictates the presentation of financial statements. Specifically, we need to examine paragraph 79.
Paragraph 79. All right, this is where the standard dictates exactly what you have to say about your share capital, right?
It is highly prescriptive. The standard setters, they understand that equity share capital is an incredibly complex concept.
It's not just a number.
Exactly. It cannot be properly summarized by just a share count and a face value. Paragraph 79 states that an entity shall disclose a very specific set of details.
Shall, not may.
Shall. Now, they can put these details in the balance sheet, they can put them in the statement of changes in equity, or they can put them in the notes. But they absolutely must be disclosed. So the company chose to put a stripped-down table in the statement of changes in equity. And I'm guessing that table failed to hit the mandatory benchmarks of paragraph 79.
You'd be guessing correctly.
Let's explore what those actual requirements are, because I think going through them really reveals a lot about what a share actually is.
Let's do that. So paragraph 79I demands these disclosures for each class of share capital. This is vital because different classes of shares have vastly different economic realities.
Right. And the first requirement on the list is paragraph 79AI, the number of shares authorized. Now, our pristine little table only showed shares that were issued, subscribed, and fully paid.
Yes.
How big of a deal is it to leave out the authorized number?
Oh, it is a colossal omission. Issued shares, those are the shares currently sitting in the hands of investors. But authorized share capital is the absolute maximum ceiling of shares that the company's founders and shareholders have legally permitted the board of directors to issue.
Oh, so it's like the total capacity of their printing press?
That is a perfect analogy. Let's look at the mechanism of why an investor desperately needs to know this. Suppose you buy into this company based on that table. You see 663 million shares.
Right. And I calculate my percentage of ownership based on that number. I feel secure.
Exactly. But what if the authorized share capital is actually 5 billion shares?
Oh, wow. Wait, really?
Yes. If the authorized limit is 5 billion, that means the board of directors is legally empowered to issue over 4.3 billion new shares tomorrow.
Without asking me.
Without having to call a general meeting and ask for your permission, they could just flood the market.
Which would instantly dilute my ownership stake to an absolute fraction of what I thought it was.
Precisely. Authorized capital represents the latent dilution risk hanging over every single current shareholder.
That's terrifying.
By omitting the authorized share count from this primary presentation, the company has effectively hidden the size of the sword dangling over the investors' heads. The math in the table was correct, but the economic reality was completely obscured.
That immediately reframes the whole picture for me. The table looked like a fortress of stability, but it might actually be a house of cards.
Exactly.
Okay, what about the next requirement? Paragraph 79AI requires the disclosure of the number of shares issued and fully paid and issued but not fully paid.
Right. So the table explicitly stated issued, subscribed, and fully paid up. So it covered the first half. but the standard explicitly requires you to address the not fully paid aspect as well.
What does that even mean? How can a share not be fully paid?
This happens when a company issues a share with a face value of, say, 10 rupees, but calls up only 5 rupees initially. The shareholder legally owes the remaining 5 rupees to the company at a later date.
So it's essentially an uncollected receivable attached to the equity.
Correct. If a company has shares that are not fully paid, it represents future cash flows that the company has a right to call upon. If a company fails to explicitly state whether such shares exist or not, the user is just left in a state of ambiguity.
Now, I know the table did manage to get a couple of things right. Requirement A asks for the par value per share, or that the shares have no par value.
Yeah.
And the table clearly stated Rs1 each share, and requirement A asks for a reconciliation of the number of shares outstanding at the beginning and at the end of the period. The table provided that, showing the 0 changes across the 2 years.
Yeah, the table handled the pure arithmetic reconciliation adequately. But then we hit the narrative requirements, which are, arguably much more important.
This brings us to paragraph 79AV, which requires the disclosure of the rights, preferences, and restrictions attaching to that class, including restrictions on the distribution of dividends and the repayment of capital.
Yes.
This seems massive. I mean, we tend to think of a share as just a digital ticker symbol on our phones that goes up or down in price. But you're saying it's way more complicated than that.
Oh, a share is not a single uniform commodity. It is a complex legal contract. It is a bundle of rights. And AS1 demands that you explain exactly what is inside that specific bundle.
I love that concept. A bundle of rights. It's almost like buying a house, right? If I buy a property, the price tag and the square footage are just numbers.
Right.
But the real value is determined by the deed. Like, can I build a second story? Am I allowed to rent it out? Is there some weird restrictive covenant that says a neighbor can drive their tractor across my lawn every Tuesday?
That's a brilliant way to put it.
If the seller only shows me a clean table with the square footage and price, but hides the restrictive covenants, I have been fundamentally deceived about what I'm actually purchasing.
That is an excellent analogy. Let's apply that directly to equity. What if the 663 million shares in that table carry severely restricted voting rights?
Okay, yeah.
What if the company's founders hold a completely different unlisted class of shares that carry, say, 10 votes per share? That would render the 663 million public shares effectively powerless in any proxy fight.
Wow, so the public investors would think they have a say in the direction of the company, but they are actually just passengers along for the ride.
Exactly. Or consider dividend restrictions. The company might have a covenant with a major lender stating that no dividends can be distributed to equity shareholders until a specific massive loan is entirely paid off.
And if an investor buys the stock for its dividend yield based purely on historical earnings,
they are walking straight into a trap. And then there is the ultimate downside scenario liquidation. If the company goes bankrupt, the repayment of capital is based on a very strict legal hierarchy.
who gets paid first?
Right. Do these specific shares have a preferential right to the remaining assets, or are they sitting at the absolute bottom of the waterfall getting nothing?
So if the table doesn't detail any of these rights, preferences, or restrictions, the investor is essentially flying blind. They know the face value, but they don't know the actual power or vulnerability attached to the asset.
And the standard continues to push for transparency into potential market manipulation. Let's look at paragraph 7 and 9 of it.
Okay. It requires disclosure of shares in the entity held by the entity or by its subsidiaries or associates.
This deals with the concept of cross-holdings, or what are sometimes called treasury shares. Think about the market dynamics of supply and demand.
Sure.
If you see 663 million shares outstanding, you assume those shares are out in the open market, being traded by independent actors, setting a fair market price.
Right. You assume it's the invisible hand of the market at work.
But what if 200 million of those shares are actually owned by a wholly owned subsidiary of the parent company?
Wait, so the company essentially owns itself.
Precisely. It is a closed loop. The subsidiary uses cash provided by the parent to buy the parent's stock.
Why would they do that?
Well, this artificially restricts the true public float. It can artificially prop up the stock price, and crucially, it consolidates voting power back into the hands of the parent company's board.
That feels incredibly sneaky.
It can be. That's why Ind AS1 mandates that this internal hoarding of shares be explicitly disclosed. You cannot just lump them into the grand total of issued shares and pretend the market is entirely external.
It's like a magician forcing a card on you. You think you have a free choice from the whole deck, but the deck is completely stacked,
That's a great way to look at it.
which makes the next requirement even more critical. Paragraph 79 to 7 requires the disclosure of shares reserved for issue under options and contracts for the sale of shares, including terms and amounts.
We talked earlier about authorized capital being the latent risk of dilution, right?
Yeah, the printing press.
Well, options and contracts represent the imminent risk of dilution.
So we are talking about things like employee stock ownership plans, ESOPs.
ESOPs are a prime example. Imagine the company has granted its executive team options to purchase 50 million shares at a massive discount, and those options vest next month.
Yikes.
Or perhaps the company issued convertible bonds a few years ago to raise capital, and those bonds are scheduled to convert into 100 million new equity shares at the end of the year.
So those aren't just hypothetical shares floating in the ether. They are ghost shares. They are already contracted, legally binding obligations just waiting to materialize and flood the market.
Exactly. If you only look at the static table of 663 million shares, you are entirely ignorant of the 150 million ghost shares about to crash into your ownership percentage.
That's brutal.
And AS1 demands that the terms and amounts of these reservations be brought into the light.
And finally, paragraph 79B shifts slightly away from the shares themselves and asks for a description of the nature and purpose of each reserve within equity.
Right, because equity is a broader category than just share capital. It includes the retained earnings from years of operations, securities premium collected from issuing shares above face value, capital redemption reserves, and various other buckets.
Okay, so why do we need to know the nature of each bucket?
Because the standard requires the company to explain the purpose of these reserves. Why? Because some reserves are legally distributable as cash dividends, while others are legally ring-fenced and cannot be touched by the shareholders under any circumstances.
Okay, wow. Let me synthesize what we have uncovered so far, because this is a lot. The company presented a table in their statement of changes in equity. It was mathematically flawless. It showed 663 million shares. But by failing to adhere to Ind AS 1, paragraph 79 within that presentation, they failed to disclose their maximum authorized printing capacity.
Right.
They failed to disclose the legal voting and dividend rights attached to the shares. They failed to show if the company was secretly hoarding its own stock. And they failed to reveal if there were massive ESOPs waiting to dilute the current investors.
It provided the illusion of total transparency while actually hiding the actual architectural reality of the company's equity structure.
But wait, let me push back on this for a second. I want to play devil's advocate for the company's finance team for a moment. You mentioned earlier that paragraph 79 offers a choice. It says an entity shall disclose these details either in the balance sheet or the statement of changes in equity or in the notes.
That is correct. The standard absolutely provides flexibility in location.
Right. And a modern annual report for a listed company is an absolute behemoth. I mean, it can easily run 250 to 300 pages.
Easily.
The primary financial statements are at the front, but then you have dozens, sometimes hundreds of pages of notes to the financial statements at the back. It is entirely plausible, even probable, that the company's finance team spent weeks drafting incredibly detailed narratives about their authorized capital, their restrictive covenants, and their ESOPs, and placed all of the beautiful narrative into Note 42 on page 185.
That happens quite often.
So if all that data is technically inside the PDF, did they actually violate the standard?
This is the crux of the entire issue. This is exactly where gap advisors focus their observation during their deep dive.
Because the information might be there.
You are absolutely correct that the company is legally allowed and in many cases often encouraged to put dense narrative details in the notes rather than cluttering up a clean numerical table. The violation is not about where the information was placed.
Okay, then what is it?
The violation is a catastrophic failure of linkage. And to understand why this is a fatal flaw, we have to look at paragraph 113 of Ind AS 1, as well as the overarching mandates of Schedule 3.
Okay, let's explore paragraph 113. What does it actually dictate regarding the notes?
Paragraph 113 is the architectural blueprint for how financial notes must be structured. It begins by stating, an entity shall present notes in a systematic manner.
Systematic.
Yes. It then explains that to determine what systematic means, the preparer must consider the effect on understandability and comparability. But the true hammer blow comes in the final sentence.
Let me read that final sentence. I have it here. It says, an entity shall cross-reference each item in the balance sheet and in the statement of profit and loss and in the statements of changes in equity and of cash flows to any related information in the notes.
Notice the phrasing there. It does not say may cross-reference or should ideally cross-reference. It says shall. It is an absolute non-negotiable mandate.
So if you have a number on the primary face of the statement and you have context for that number in the back, you must explicitly connect them.
Yes, you must build that bridge. And I assume you can guess what the company failed to do in this case.
They presented the table of 663 million shares in the statement of changes in equity, but they provided absolutely zero cross-reference, pointing the reader to wherever the paragraph 79 disclosures were hiding in the notes.
Exact.
There was no hyperlink, no parenthetical saying, see note 15, no map at all.
Nothing. And this requirement is not just an accounting standard idiosyncrasy. It is deeply embedded in the corporate law of the country.
Right, I'm looking at the Companies Act 2013 right now. Specifically, Division 2 of Schedule 3, Clause 4.2 of the General Instructions. It mirrors Ind AS 1 almost perfectly. Each item on the face of the balance sheet, statement of changes in equity, and statement of profit and loss shall be cross-referenced to any related information in the notes.
The legal framework and the accounting framework are moving in absolute lockstep here. But Schedule 3 includes a deeply philosophical sentence right after that mandate, which really gets to the very heart of why financial reporting is so incredibly difficult.
Oh, what does it say?
It says, in preparing the financial statements, including the notes, a balance shall be maintained between providing excessive detail that may not assist users of financial statements and not providing important information as a result of too much aggregation.
That is fascinating. It's openly acknowledging the core tension of corporate reporting. It's a tightrope walk.
It truly is. Standard setters are well aware of the conflicting demands placed on a financial document. If you force a company to put every single detail, every legal clause, every ESOP strike price, every dividend restriction directly onto the face of the statement of changes in equity, the document becomes an unreadable nightmare of text.
Yeah, that's the danger of excessive detail. The primary numbers just get lost in the noise.
But on the flip side, if you just aggregate everything into one clean line that says equity 663 million, you commit the sin of too much aggregation, where you completely hide the vital context.
So they want it both ways.
Precisely. The standard setters want you to aggregate the core numbers on the primary face so they are readable. But they only permit you to do that if you provide a clear, unmistakable bridge to the disaggregated details in the notes. The cross-reference is that bridge.
Let's visualize how this failure actually plays out for a reader. Think about how we navigate the internet today.
Okay.
If you're reading a Wikipedia article about a historical event, and there's a really bold claim made in the text, you expect to see a tiny little blue hyperlink or a bracketed number pointing to a citation at the bottom of the page.
Right.
That hyperlink is the cross-reference. It tells you, hey, there is proof and context for this claim. Click here.
Exactly. Without it, you just have to blindly trust the text.
Right. So what this company did is equivalent to writing a massive, controversial Wikipedia article, putting all the brilliant citations and context at the very bottom of the page, but refusing to put any hyperlinks in the main text.
That's a fantastic analogy.
The reader sails right through the article, completely unaware that the context even exists. They assume the surface-level text is the entirety of the story.
The reader is left marooned on the surface. And this is exactly what Gap advisors zeroed in on during their independent review. They tracked the disclosure, spotted the missing bridge, and concluded the company has not cross-referenced the note disclosing the details required by paragraph 79 from the Statement of Changes in Equity. This is not in accordance with Ind AS 1 and Schedule 3 to the Companies Act 2013.
Okay, I follow the logic perfectly. It makes total sense. But I have to ask, how big of a deal is this, really?
It's a massive deal.
Well, if I'm a cynical finance professional listening to this, I might be rolling my eyes right now. I might argue, look, it's a 300-page PDF. It has a search function. If an institutional analyst really cares about authorized capital or ESOPs, they know how to hit Ctrl+F and search for the keywords. Is missing a simple C Note 15 really a catastrophic failure, or is Gap advisors just being pedantic about formatting?
You know, it is an incredibly common defense mechanism to dismiss this as mere formatting. But Ind AS 1 anticipates that exact cynical argument, and it aggressively rejects it.
Oh, really?
Yes. The accounting standards do not view a missing cross-reference as a typo. They view it as a structural failure that can actively mislead markets. To understand the severity, we have to transition from the rules of presentation to the definitions of misconduct.
Misconduct, that's a strong word.
We need to look at paragraph 7 of Ind AS 1 and the legal definition of obscuring information.
Obscuring information, that phrase alone has a very deliberate, almost sinister weight to it.
The language is chosen very carefully by the standard setters. Paragraph 7 formally defines what it means to obscure information. It states, information is obscured if it is communicated in a way that would have a similar effect for primary users of financial statements to omitting or misstating that information.
Let's just pause and let the gravity of that sink in. The standard dictates that if you obscure information, it has a similar effect to omitting or misstating it.
Exactly. Let's define those terms in an audit context. Misstating information means the numbers are flat out wrong. It implies incompetence or outright fraud.
Right.
Omitting information means you actively hid the truth by refusing to disclose it at all. And AS1 is stating unequivocally that obscuring information belongs in that exact same severe category.
So the defense of, well, it's in the document somewhere, just use the search function, is completely invalid. The standard is saying that making information unreasonably difficult to find is functionally and ethically equivalent to lying about it or hiding it.
Exactly. If you have to launch a keyword expedition to find the legal restrictions on your shares, the company has failed its fundamental duty of transparent communication.
It's like scattering the pieces of a jigsaw puzzle all over a giant mansion, turning off all the lights and telling the buyer, well, the whole puzzle is technically in the house. It's your fault if you can't see the picture. Paragraph 7 is essentially saying that scattering the pieces is the exact same as throwing the puzzle in the trash.
A very apt description. And paragraph 7 actually provides a specific, itemized list of circumstances that result in material information being obscured. It is essentially a checklist of bad corporate habits. Let's walk through them and see exactly how our company's missing cross-reference triggered these definitions.
All right, I have the list here. Let's go through it. Example A. States information is obscured if information regarding a material item, transaction, or other event is disclosed in the financial statements, but the language used is vague or unclear.
We can likely acquit the company on this specific point. The issue here wasn't that the note itself was written in confusing legalese. The issue was that no one was directed to read the note in the first place.
Makes sense. Moving to example B. Information is obscured if information regarding a material item, transaction, or other event is scattered throughout the financial statements.
And there is the direct hit. This describes the structural failure perfectly.
Right. By failing to build the bridge, the cross-reference, the company took a cohesive concept, equity share capital, and violently fractured it. They put the comforting static numbers on page 10, and they exiled the terrifying latent dilution risks to page 185. They scattered the material information.
Exactly. The primary numerical statement was orphaned from its narrative context. Let's continue through the list as it illustrates other methods companies use to hide the truth.
Okay. Example C. Dissimilar items, transactions, or other events are inappropriately aggregated.
This is a classic tactic for hiding toxic assets or underperforming divisions. Imagine a company has two revenue streams. One is from selling high-margin proprietary software, and the other is from occasionally selling off their old, broken office furniture.
Okay.
If they inappropriately aggregate those two vastly different things into a single line item called miscellaneous income, they're obscuring the true deteriorating nature of their core business.
Sneaky. And example D is the inverse. Similar items, transactions, or other events are inappropriately disaggregated.
This is an attempt to exhaust the reader. It's taking a single, simple liability and breaking it into 40 microscopic, separate line items scattered across the balance sheet so that an analyst can never easily calculate the total burden.
Wow.
You prevent them from seeing the forest by forcing them to count the leaves on every single tree.
And the final method, example E. The understandability of the financial statements is reduced as a result of material information being hidden by immaterial information, to the extent that a primary user is unable to determine what information is material.
In the industry, we call this disclosure overload, or kitchen sinking. It is a highly sophisticated way of hiding information.
How does that work?
Well, a company knows they have to disclose a devastating piece of news, perhaps a massive pending lawsuit that could bankrupt them. So they bury that one critical sentence in the middle of 60 pages of dense boilerplate, utterly irrelevant text about minor operational procedures.
Unbelievable.
The material truth is technically there, but it is entirely hidden by a mountain of immaterial noise.
It's hiding a needle in a haystack of compliance jargon.
Precisely. Now, Bringing it back to Gap Advisor's synthesis of our specific case study, the logic chain is airtight. Step 1, the company was mandated by Schedule the Third in paragraph 113 to provide a cross-reference linking their equity table to the notes.
Right.
Step 2, they failed to provide that cross-reference. Step 3, this failure caused the material information required by paragraph 79 to become scattered throughout the financial statements.
Following.
Step 4, according to paragraph 7, example B, scattered information is obscured information. Step 5, obscured information is treated with the same severity as omitted or misstated information.
The conclusion is inescapable. The financial statements, despite having perfectly balanced math, are fundamentally non-compliant because their presentation structure obscures the truth.
It is a profound realization for anyone involved in financial reporting. The mechanics of presentation, the cross-references, the aggregations, the indexing, they are not administrative afterthoughts. They are the structural integrity of the financial statement. If the structure fails, the transparency fails.
It really makes you appreciate the immense pressure on the professionals tasked with creating and reviewing these documents. I mean, if you are a CFO, an audit partner, or a finance controller, you are signing your name to hundreds of pages of complex intersecting data.
Yes, you are.
Knowing that a missing set of parentheses and a note number can unravel the compliance of the entire document, it is a terrifying game of millimeters.
It is an incredibly high-stakes environment. The sheer volume of standards, the constant updates to Ind AS, and the nuanced intersections with the Companies Act create a massive cognitive burden. You simply cannot rely on institutional memory or gut feeling, or just copying last year's template.
Which perfectly sets up the final and perhaps most vital segment of our deep dive today. We've thoroughly diagnosed the pathology, how information is obscured through broken cross-referencing. Now, we need to talk about the antidote.
Let's do it.
How do audit teams, finance professionals, and corporate boards protect themselves from falling into these exact traps?
The primary defense mechanism is recognizing that you cannot navigate this complexity in a vacuum. You need access to specialized, dedicated expertise.
And that brings us to the core utility of Gap Advisors. Listeners, if you are involved in any stage of financial preparation or auditing, you need to be aware of the resources available at gapadvisors.com. The platform is not just a blog, it is a massive, highly specific issue repository.
The scale of it is what makes it so valuable. The repository currently hosts over 4,500 distinct issues and detailed standard-backed responses regarding the application of both Ind AS and Indian GAAP.
Over 4,500 issues. That is not a theoretical textbook, that is a living database of the exact edge cases, ambiguities, and formatting nightmares that finance teams are battling every single day.
Exactly.
And the accessibility is brilliant. Any person can register on gapadvisors.com for completely free. Once you are registered, you aren't just browsing a static FAQ. You can submit your own specific thorny issues on Ind AS and Indian GAAP.
And you receive a detailed, rigorously researched response delivered directly to the inbox of the email you registered with.
Let's talk about the practical application of this, particularly for auditors.
Right.
We know that the lifeblood of an audit file is documentation.
It is everything. For an auditor, it is never enough to simply look at a complex equity structure and think, yeah, that looks okay. The regulatory oversight on auditors is intense.
Right.
When an auditor encounters an ambiguous presentation, perhaps a convoluted mix of compound financial instruments or a bizarre revenue recognition contract, they must thoroughly document exactly how they addressed the issue and why they concluded it was compliant with Ind AS.
They need a bulletproof paper trail of their logic.
Exactly. Being able to query a repository of 4,500 resolved issues or submit a specific highly technical question to Gap Advisors and receive a documented expert response is an incredibly powerful tool. It provides the external, authoritative backing that an auditor needs to fortify their audit file against future regulatory scrutiny.
That makes total sense.
It transforms an educated guess into a fully documented, standard-backed conclusion.
It's essentially an in-days lifeline that you can integrate directly into your workflow. But, the responsibility doesn't begin and end with the auditor. What about the companies themselves, the management teams who are actually drafting these 300-page behemoths?
This is a critical distinction. The auditor expresses an opinion on the statements, but the financial statements themselves are fundamentally the property and the responsibility of the company's management. The board of directors signs off on them.
Right.
And as we saw clearly in today's deep dive, the finance team can easily miss a vital cross-reference that technically obscures material truth.
So what is the proactive strategy for a company?
My absolute strongest recommendation for corporate management is this. Do not wait for the auditor to find the missing asterisk.
All right.
Do not wait for a regulatory body to flag a compliance failure months down the line. Take ownership of the presentation quality by getting your financial statements reviewed by GAAP advisors before you sign them.
Ah, a pre-flate check for your financials.
Precisely. It is an incredibly effective risk mitigation strategy. Companies can submit their drafted financial statements in a near-to-publishing PDF format directly to GAAP advisors. The process is seamless. You just email the PDF to info@gapadvisors.com.
It seems so incredibly logical. Why would a company risk presenting obscured information to the public markets when they could have an independent, highly specialized set of eyes review the document for exactly these types of structural flaws?
They really should.
Having DAP advisors review the cross-referencing, the aggregation levels, and the narrative linkages before the document goes public could save a company from immense embarrassment, loss of investor trust, and brutal regulatory penalties.
It is the difference between reactive scrambling and proactive confidence. The Indian accounting standards, at their core, are designed to protect the primary users, the investors who are risking your capital.
Exactly.
When a company utilizes tools like GAAP Advisor's pre-publishing review, they are sending a powerful signal. They are proving that they aren't just trying to do the bare minimum to tick a compliance box. They are actively investing in transparency. They are ensuring that the story their numbers tell is cohesive, fully linked, and completely understandable to the market.
Building long-term market trust through absolute clarity. I think that is a phenomenal framework for how companies should view compliance. It is not a burden. It is a communication strategy.
Well said.
We've covered a vast landscape of financial philosophy and regulatory rigor today. We started by looking at a remarkably simple, perfectly balanced table of 663 million shares that projected an illusion of total stability. We stripped away that illusion by diving into the intense narrative demands of Ind AS 1 paragraph 79, exploring the hidden dangers of authorized capital headroom, restrictive covenants, cross-holdings, and ghost shares.
We examine the architectural failure of the missing cross-reference under paragraph 113 and Schedule 3, illustrating how the bridge between primary numbers and vital context is non-negotiable.
And finally, we confronted the harsh, unyielding reality of paragraph 7, that scattering information through broken links functionally obscures the truth, rendering the entire document as flawed as if the company had simply lied. It has been a masterclass in why the minutiae of presentation standards are the true guardians of financial transparency.
It's been a great discussion.
As we draw this deep dive to a close, I want to leave you, our listener, with a final, slightly provocative thought to mull over in your own work. We have just spent the last hour demonstrating how a single missing line of text, a simple bracketed C Note 15, possesses the power to legally transform a perfectly balanced financial statement into one that is obscuring material truth.
If a simple missing cross-reference equates to obscured, misstated information, what other supposedly minor or immaterial formatting choices in the complex documents you review, audit, or prepare every single day might actually be hiding material truths? Are you ever truly seeing the complete picture, or have the puzzle pieces been quietly scattered just outside of your immediate view?
A brilliant and vital question that every finance professional must carry with them. Thank you so much for your expert guidance today, and a massive thank you to you, the listener, for dedicating your time and your curiosity to this deep dive. If this breakdown provided you with a new perspective, or if it gave you an aha moment regarding how you view financial statements, please do us a massive favor.
Please do.
Share this podcast among your professional network. Send the link to your contacts and colleagues. Share it vigorously with your audit and finance teams so they can tighten up their own review processes. And absolutely pass it along to any students you know who are currently pursuing their CA course. This is exactly the kind of practical structural analysis they need to complement their theoretical studies. Our goal is to spread the vital working knowledge of Indian accounting standards as widely as possible, and your word-of-mouth recommendations are exactly how we achieve that.
Elevating the understanding of these standards elevates the integrity of the entire profession.
It truly does. And finally, to ensure you never miss an analysis like this, please take a moment to follow or subscribe to the GAAP Advisors Ind AS Clinic podcasts. You can find us on Spotify, Amazon Music, or YouTube, whichever platform you prefer for your listening. Hit that subscribe button, and we will see you back here for the next exploration into the mechanics of business. Until then, keep questioning the narrative behind the numbers, and always, always check for the cross-references. Thank you for your time.